Good morning, good afternoon, and good evenings. Whenever you're catching up with this update, we got some, like we do every Tuesday at noon 30 Mountain Time. It is time for the Get Fundable financial status update. And have we got some exciting things going on literally this week? All right. Two massive storms are coalescing into creating financial opportunities for those of us who are fundable. What am I talking about? First things first. In a recent Wall Street Journal article, it said that the headline says credit card debt keeps falling. Banks are on edge. That's the Wall Street Journal front page ad, you guys. So it was an unpredicted outcome of COVID was a significant paying attention by borrowers everywhere to get out as much debt as possible. Many people were using their stimulus package payments or extra payments that were coming in from their unemployment benefits to reduce debt. Now, it makes sense, right? If you've got this debt, you want to maintain good credit, you want to keep your relationships with the banks, and so you're going to do what it takes. But when we lose a job, but we're getting these extra benefits, or when we get a stimulus check, if some of us got what was the first one was $1,200, the second was $1,400, among others, depending on your state and your communities. There were all kinds of things that were happening that might have put extra money into millions of borrowers' hands. Well, many of those borrowers reduced their debt, especially credit card debt, because that's the highest interest rate, right? So the problem is that it's interest rates are the single highest revenue source for credit card issuers. Banks love folks paying that 18, 21, 22% interest. Now, it is the second largest revenue stream. Their first largest revenue streams are for credit card swipes. Every time you use their credit card, they're collecting money through merchant processing fees. All right. So over in this storm that's happening is even post-pandemic. So 2020 came and went, came into the spring. Things have been lightening up here, spring over summer, and the banks seem to be borrowers who are being reemployed, moved to the gig economy. Whatever happened for them, each one of many borrowers continue to pay off their debt. So the amount of interest that credit card issuers and banks are receiving from these interest payments is going down. How do they respond? Well, let's talk about. I'm mistaken. There are three perfect storms happening at the same time. So we've got, because of COVID, because of people playing financially conservative, they're reducing their debt. The second one is COVID. We'll talk about this Delta variant in a minute, but for a period of 2021, there's been a broadening of the financial markets. There's been masks weren't required. The mandates for masks were being released. Businesses were opening, employees were coming back, marketing plans were being pursued and augmented. And so business and the economy have begun to reestablish itself, right? We've been able, unemployment is down, and huge movements in returning to increasing the economy. Some folks have even said that because there was such a fast ramp up this spring that we're running a little hot, and they're looking at interest rate increases. The Fed most recently is still says that the interest rate increases are further out and not imminent. And so we're saddled with the extremely low interest rates as we build out of this pandemic recession-esque type environment. All right, so there's the second storm. That storm is alleviating, but that second storm is putting more money in more people's pockets as they return to work, and they're still paying down debt. So that leaves an expanded marketplace and people still paying down debt, reducing the bank's reducing the bank's revenues. Now, I will kind of re-report something we talked about 2 or 3 weeks ago. Is that the second quarter postings of the big banks, the top 4 banks, Wells, Bank of America, Citi, and Chase. Those 4 banks posted together as aggregated profits over 20 billion in profits, compared to, I believe it was 6 billion the same quarter in 2020. So I've been talking about banks are insanely well capitalized now, and there's money to lend. But we got perfect storm number 1 is everybody's paying down their debt. They're not making as much money. Lenders have tons of money to lend, and the borrower population is expanding because more and more people have access, are back to work, or are off furlough and moving back into their jobs. Now, the third storm is that there is right now, and this is from American Banker that came out yesterday, that banks are easing because we're losing, we're credit card debt is falling and the revenues from interest are falling. And because of this easing up, or more borrowers are back in play, that banks are now easing up their lending criteria, their lending their standards across all loan types, credit cards, auto loans, mortgages, because first of all, the demand, more and more borrowers are coming back into play, and a greater and better economic outlook over the next 3 quarters as it's predicted, right? So most banks kind of close that down. And if any of you watched my boot camp, if you watched any of my my presentations, we talked about that that the target of borrowing in prosperous times, you can hit on the outer rings. You still got to be fundable enough to hit the target, but they would lend to the outer rings of this target, right? If your scores are in the 680s and 700s, they very well may lend to you. But when they constrict, then they still lend, but only to those bullseye borrowers and the inner ring. So you've got to be highly fundable. And that's what we focus on. My entire mission is to teach you and make sure that everybody has the fundamentals of how to become fundable and be in those inner rings. Well, guess what? That small target that collapsed over the course of the pandemic and COVID is now expanding. And the lenders are reporting higher risk tolerances, meaning we're willing to lend to folks who over the last year and a half we haven't been willing to lend to, except for highly fundable. But here's the magic, you guys. The outer ring, let's say you're an outer ring borrower, you got a 680, 700 something, and I'm not talking the score, I'm talking a fundable profile, but you're only a 680 fundable versus a 700, 760, 800 fundable borrower. Interestingly enough, you might get an approval for 5,000 on one of the outer rings of this funding approval target, right? To use my metaphor. But as the rings go in, the approval amounts go up. So if it's 5,000 on the inner ring, the next one might be a $10,000 approval. This is what they mean by higher risk tolerance. The closer you get into that borrower bullseye, and that funding bullseye, the higher your approvals are going to be, to the tune of, and we've had just today in our team, we celebrate our clients' funding wins, right? Just today, we had 2 clients under the 6-month mark, because most banks will look at you and raise your limits every 6 months. 2 of our clients reported back that they had over 200% increase in their credit limit. One went from $1,600 to over $6,000 in the limit, a bump from $1,600, boom, bump to $6,000 credit limit. Another was around $6,000, $4,000, and went to $14,000, almost a 250+% increase. These were both automatic underwriting, meaning no inquiry, no request from the borrower or our client, no income verification, nothing. They were watching the internal performance data of that client and said, we're going to give them more money. But instead of giving a 50% increase, it was over 250%, you guys. 250% increase, $4,000 to 14. The reason is because these borrowers, as clients, know what their fundability metrics need to be and what the 40 borrower behaviors that all these banks and credit card companies are measuring. They know what they're meeting those perfect borrower guidelines. They are amazing and perfect borrowers for these banks, and so they're getting higher and higher approvals. I'm going to predict through the end of the year, these banks are going to continue to give higher funding approvals through these automatic underwriting. Now, what does this mean, though? Well, you're getting more money without having to ask for it. Your borrower behaviors are enough for them to measure and say, these folks deserve more money. But simultaneously, they're loosening the underwriting guidelines. They're expanding it. So the more fundable you are, the more close you are to that funding bullseye, you guys, the higher your approvals are going to be. This is if this were a gold rush, we'd be saying eureka, because this is free money. Now, the second one, the one that went from 4,000 to 14,000, guess what? Their next approval was after only 3 months of the borrower guidelines. So they got an increase in their profile last February, and in May they got an additional this 250+% increase after only 90 days, 120 days. That is the power of automatic limit increases. That's the power of fundability to drive higher approvals. Now I sent my team out after all this good news. After I was preparing this, Guy did all this, all the research to bring all this together. We culled these examples, case studies from our clients. We're now guarantee that your business lines of credit are going to be experiencing the same caliber of credit limit increases, automatic underwriting increases. So a significant number of the banks, you guys, this third perfect storm of the three that are going on at the same time, they are lowering their credit score standards for these higher approvals, because they want to keep, remember, the CEOs and the boards of all of these big banks, when they meet, they're looking at quarterly targets. And if revenue from interest, collecting interest payments on debt, credit card debt, if that's waning, then they're going to want to increase these, and more offers are being sent out. So anticipate a flood of credit card offers coming to you. Now, as I've said before, I want to close out this update with two things. Number one, do not respond to an offer. Do not put in the code. If you like what's being offered and it's part of an overall plan that you learned at the boot camp, or you as a client, if it's part of an overall growth of your revolving account portfolio and you like the offer, then contact the bank or credit card issuer directly and ask them for an application and to do it that way, rather than, because we don't want you on that mailing list, that susceptibility Siegel borrower mailing list. Okay. And if you want more information on that, go to getfundablebootcamp.com and join us. You're going to learn how to protect your borrower identity and how to protect your borrower reputation. Vital that you get this intel if you haven't got it already. But Second thing I want to leave you with is the idea that we together, you and me, we have made it through this first portion of a financial and economic decline as a result of the pandemic. We seem to be coming out, and everybody's been predicting now with this Delta variant, we might have a W recovery, right? We go down, we recover a little bit, we may go down again with the Delta variant, and then continue our recovery. What I want you to get is that I've been here every step of the way, just jumping up and down, trying to get you to realize the power of being fundable, the power that you can be in charge of your funding approvals. And we had clients, we're up to $45 million during this COVID alone of approvals, over 45 million in approvals during COVID. That's going to skyrocket coming out of this. We're already having clients getting 200+% increases through automatic limit increases. Didn't ask it, no inquiry, no income verification. Here's 2.5 times the money that we had given you in the past. You guys, we got to get on board, got to get on the same page. And that's what my mission is about, is borrower education. Make sure you know how this game is being played. And the way to do that is, if you haven't done so, go to getfundable.com and join me at the next boot camp. If you have, the dates and times and everything are there. If you have already gone to the boot camp, then either come and join me again, or go back into the Funny Hackers Facebook group and watch the past boot camps, because I'm teaching the fundamental principles of how to be that bullseye borrower, how to score the highest possible approvals, regardless of of recession, prosperity, whatever the conditions out there are. Lenders only make money when they lend. So this update, to recap, if you're just joining me now, 3 financial perfect storms occurring. Credit card debt. Borrowers are paying off credit card debt like they never had in the history of the record keeping. There's a run on paying off credit card debt. Banks are on the edge because their second largest revenue source is interest payments from borrowers. Same time, COVID seems to be, besides the Delta variant, things are expanding. And or if some people are, if you've gotten the argument goes that if people have gotten the vaccine, then we might not have a serious dip again, right? That I leave that to you. I'm saying that regardless of whether we're going down or going up, if you're fundable, money is available to you in vast amounts. 250 just today, 2 clients had over 250% increases in their credit limits. Let's do this, guys. Let's do this. I love having a pulse on this. I love having a pulse on what lenders are doing and how we can become their perfect customer. This is Merrill Chandler. Thank you for joining me in this weekly Get Fundable update, and I will see you. Please, if this it makes sense to you, if you like this, like it, share it, send it out to your loved ones. Let everybody know what's happening out there right now so that they can prepare themselves to become more fundable as well. This is Merrill. Please join us next week. Same bat time, same fundable time, same fundable channel. It's noon 30 on Facebook, where you are now. Noon 30 every Tuesday. That's not a holiday. Mountain time. Have a great and blessed day.